Welcome to TradeTheMBI.com. This is John. This report is for the 16th of October. Well, we talked about the positive extreme right there and what the retrace value was going to be. And that's exactly what we did. So that was pretty clean. Again, shorts faded off on that because they were happy to collect off of it. So that really erased a lot of that MBI white pressure that was pushing into it. Just lack of enthusiasm from a bull standpoint to fight that. And actually very healthy in filling in that positive extreme early. Doesn't have to be dealt with again. NASDAQ didn't have one. And that's been the weaker part of everything because you can see how lagging the Nasdaq has been, relatively speaking, to making new highs to the S&P. So opportunity for the Nasdaq to catch up, yeah, but they're not taking advantage of it, and that's because we saw a much stronger short presence from a Nasdaq standpoint, and that was enough to just escalate things. But all it did was fill the S&P's positive extreme, so nothing that dramatic, but still not quite congruent as far as their readings. And of course, Treasury softening up just a little bit from a yield standpoint. Again, this is where bond traders last couple of years have just been way on the wrong side of everything as it relates to the Fed, and not recognizing that the Fed was just doing things from a political standpoint as opposed to an economic standpoint, because based on all their numbers, there was no justification for what they did. Now, we can talk about liquidity, banking crisis, those kinds of things, because under the hood, yeah, there's some engine problems with the way things are, and it's mostly related to credit situations, and that has nothing to do with the real economy that's taking place, but the financial one and the clogging of the system, so to speak, simply because there's a lot of risk exposure and people are trying to mitigate that, and it's really starting to build up some stumbling blocks. And I think that's going to be the real question going forward as we move to the end of the year. Will there be some type of credit crisis simply because of the Fed's behavior and where they're forcing money allocations? And particularly if you end up with any softening in the economy, and that what happens to a lot of this exposure, and that really is it's not an unknown because we know what will happen. I think that's what their fear is, which is why they've been trying to tamper more with the rates, because it's not about an economic situation. This is about credit and the fact that there's been overexposures in a lot of areas, and they don't know how to ease that off at this particular stage, and it's a big threat. And people don't realize it because it's not something that's readily talked about or known. And of course, important things like this, where energy and that is it becoming cheaper simply because there's an excess supply, which means there's a lack of demand, or has it just been a relative situation where it's gotten out of control from an inflationary standpoint? And there's a little bit of both of all of those built into the dynamic that's taking place at this particular point. At the end of the day, most of these suppliers, and they're not going to take the haircut from a deflationary move of price, as far as where we have the dollar in its relationship of decaying value. And that's really what this comes down to. And that's why you're going to maintain an elevated oil price, simply because of the decay in dollar value. It's not about the overall supply in that. Now, obviously, when you have demand failure and that, yeah, there's going to be some retrenchment, but most of that is just the inflationary buildup. Euro, of course, having been propped up like it was, but the Eurozone showing seriously no activity whatsoever from a growth standpoint. They're thrilled if they can maintain a 0.3% growth rate. Completely ineffective. And so the idea that if they're comparable economy and not growing at all relative to the US, why is the euro, greater than subpar? It makes no sense to the dollar, other than you're devaluing the dollar with that massive spending, which is the reality of it. Because if you had cut back any spending at all, you would have a euro that's 85, 90 cents to a dollar at best. So those are real topics, and it shows in real terms what the deficits that we're underwriting, that's the effect. And your global purchasing power is greatly reduced. And this is why you're going to see this continuing to move in this up line, and it's not going to stop. It's relatively, even back when we were looking at it down in the 2000, 1800, even at 1600, I was telling what a, fantastic a deal it was, that it was only going to continue to rise based on the trajectory of what the U.S. is doing from a financial standpoint. And this is the systemic threat. And I mentioned that this would lead to this exact move, Bitcoin rising, all the other cryptos and that. And of course, it becomes a bit relative to the dynamic of where things are at the particular time. I mean, we saw a lot of difficulties with crypto in their regulatory situations and just some of the shenanigans that take place. But overall, people are desperate for an alternative to the dollar as a support for diminished, value returns, and that's exactly the situation. This is why you see the market rising, because again, it's not taking that haircut from a value standpoint because of the devaluation of the dollar. So we had marked positive extremes for the 50K, and it was just a matter of waiting for the signal, which came relatively early in the day. Did the report back here. We're just starting to see some signs of weakness, but it was still relatively low from a MBI white standpoint. That shifted pretty much by the middle of the morning, and once it began, we got our move down to 50%, which ironically corresponded to exactly where the positive extreme was. And we actually flew past it a little bit, but they were just testing to see how much additional supply there was, and obviously there wasn't that much, and it attracted buyers, and we moved right back up to this, same level. So that's all fairly clean. It wasn't any surprise. You can see how it was here as we started, and boom, started to decay. We actually got the shorting signal prior to even the market open from that standpoint, and then it just cascaded all the way through the day. And of course, right now things are relatively flat in the post market. They had pushed back up a little bit, but again, this is what we talked about. You had the massive call buying, and of course that puts a lot of exposure from an options play. So they counted it all and wiped out all of that gamma, and you move it right back to the same part of the needle. And this is what the markets do. You look for advantage to one side, move back to the other side when there's too many people going in one direction, and you have basically equilibrium. And that's the whole point of the mean reversion aspect of the S&P. Not a surprise, and that's why I say continue to follow the paint bars, because it can see it and it's pretty straightforward. As always, though, anything relevant, I'll put in the Skype chat for you. Have a good one. Trade well.